3 days, March 10th, it will be the one-year anniversary of the failure of the Silicon Valley Bank. SVB marked the third largest bank failure in U.S. history and certainly the largest since the 2007-2008 financial crisis. I've said it many times before, and I'll say it again today, that there are three major components to SVB's failure. First, the bank was rife with mismanagement. Second, there was a clear supervisory failure, and our regulators were certainly asleep at the wheel. And third, President Biden's reckless spending caused record high inflation, which resulted in drastic interest rate hikes and tremendous loss. When you print and spend trillions of dollars at the end of COVID, we should not be surprised that we have record high inflation. Record high inflation translates into today still 40% higher for gas for your car, 30% higher for your food, 20% higher for your energy costs. The devastation the average American is facing because of Bidenomics is undeniable, but certainly measurable. So I'm glad to spend some time talking about the state of our economy, an economy that has been ravaged, as I've just spoken about, by inflation, suffering under the weight of an open border and millions of illegal immigrants, and drowning in disastrous regulations. I hear from my constituents all the time that inflation and an unsustainable cost of living continue to impact their families. For far too many, the American dream seems further and further out of reach than ever before. And frankly, the past 3 years of this administration's failed policies have landed us right in that spot. In fact, last month, Treasury Secretary Yellen sat before this committee and attempted to spin a narrative of how strong the economy is, how well.
There's been a hearing today with the chairman of the Fed, Jerome Powell, and something I don't really understand, and I'm being honest with you because I thought about this, and maybe I'll take your opinion on it. MENDEZ, when I last checked, MENDEZ is subject to investigations with regards allegations of financial corruption. But he's allowed to sit in on a hearing of financial matters. Am I missing something? Let me know.
Well off consumers are and how much people have in the bank thanks to Bidenomics. But in the midst of this, she also admitted that many prices are not going down. In fact, she said, and I quote, "We don't have to get these prices down." Tell that to the mechanic working in South Carolina. Tell that to the teacher trying to put gas in the tank. It is simply unacceptable. Because the truth is that Americans are now spending more of their income on food than they have in 30 years. The truth is that housing affordability remains at its lowest level in 40 years. But inflation isn't the only concern I'd like to raise. I'd also like to address the economic impacts of illegal immigration. During your recent interview on 60 Minutes, you stated that over time, the U.S. economy has benefited from immigration. Let's be clear. America is a nation of immigrants, no doubt. But when we talk about illegal immigration today, we must also face the dire reality that our towns and our cities are suffering from the adverse impacts of illegal immigration facilitated by the Biden administration's open, unsecure, and unsafe southern border. Because of President Biden's policies, we've seen over 7 million illegal immigrants cross our borders in just 3 years. By the time this election happens this year in November, the numbers suggest it could be as high as 10 million illegal immigrants coming into our country. So we cannot have an honest conversation about the benefits of legal immigration in our labor force without also addressing the elephant in the room. Our country is strained. Our economy is strained under the weight of illegal immigration. In fact, recent reporting has highlighted that cities and states across our country are struggling to keep pace, and some have been forced to cut public services to Americans in order to fund the cost of feeding and housing illegal immigrants. One clear example we saw in New York City were the poorest kids in the city, minority kids in the city, were stuck at home because the city was using the schools to house illegal immigrants. Another example, the city of Denver recently announced that some of its employees may have their hours cut in order to reallocate funds toward the city's migrant crisis. How in the world is that fair to Americans? It's not. We must get the illegal immigration crisis under control, because if we don't, our local economies will continue to be crushed and opportunities will continue to be stripped from our citizens and their families. Finally, as if inflation and the negative impacts of illegal immigration were not enough, the tsunami of regulatory red tape coming from our financial regulators further threaten economic opportunity across the board. For months, we've heard bipartisan criticism of the Fed's Basel III endgame proposal, which will restrict lending and access to credit for those who need it the most. I was certainly pleasantly surprised to hear your comments about Basel III and your thoughts on its future. When 97% of the comments that you receive are negative, that's good news. Good news for the American consumer, good news for entrepreneurs who would like to start a business but do not have access to capital, perhaps even good news for millennials who would love to become a first-time home buyer. The opposition to Basel III comes from diverse array of interests, from community leaders, farmers, to housing groups. We've even heard opposition in this very room, on this very committee, from Democratic senators. I look forward to hearing your testimony and looking forward to asking some questions as well.
Thank you, Senator Scott. We'll hear today, as we do every 6 months at least, from Chair of the Federal Reserve, Jerome Powell, on monetary policy, the state of our economy. Please proceed. Thank you for your service to our country.
Thank you, Chairman Brown, Ranking Member Scott, and other members of the committee. I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report today. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined, and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices, or PCE prices, rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Longer-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We have also continued to shrink our balance sheet at a brisk pace and in a predictable manner. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% inflation objective is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress that we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Mr. Chairman. You've acknowledged the Fed likely waited too long to raise rates when prices...
That in the past year, we have seen the first Latino Federal Reserve governor and the first ever Latino Federal Reserve Bank president. These are historic milestones that show we are finally making progress, something that I have been at for quite some time, to the leadership of our economic institutions. So I want to applaud that. And Mr. Chairman, I hope that progress can continue and extend to the rest of the Federal Reserve staff.
Thank you.
I agree with my friend, the ranking member, that when you tell a story, you should tell the whole story. Mr. Chairman, are you aware of the Washington Post February 27th article that says the economy is roaring and immigration is a key reason?
I don't recall that, but I would have read it.
Let me read it to you. Immigration has propelled the U.S. job market further than just about anyone expected, helping cement the country's economic rebound from the pandemic as the most robust in the world. It goes on to say, economists and labor experts say the surge in employment was ultimately key to solving unprecedented gaps in the economy that threatened the country's ability to recover from prolonged shutdowns. Would you take issue with those statements?
You know, there are a lot of adjectives and adverbs in there that you wouldn't see in Fed world. But the
take out the adjectives and give me on the substance.
The story is I think broadly this. It is that there was a very significant increase in the size of the workforce last year, and it was happening all during the year, and we were wondering what it was. And the answer was it was really two things. It was labor force participation, but it was also immigration. And if you look at the Congressional Budget Office numbers, it kind of makes sense because there was a lot of growth. Wages were coming down. The economy is bigger. And those are probably in part affected. This is without making any judgments on immigration or immigration policy, but I think that's an economic fact.
I'm not suggesting that. I'm just suggesting the facts are that we had 10 or 11 million jobs that were going unfulfilled in our economy. They lacked the productivity that is necessary for success economically. And as part of that, clearly, immigration helped fuel part of our revival coming out of the pandemic. In fact, those were the people who were the essential workers when the rest of us were staying home. So I agree we need to do what is necessary to have a regularized border. But I also think that just to create the context of immigration as a scourge is absolutely wrong. Let me turn to another question. In my view, the sticky inflation we've been seeing in the housing sector is principally due to the massive nationwide housing shortage. The Fed's monetary policy report attributes the shortage to restrictive zoning, high interest rates, and tighter underwriting by banks. I would also add to that list underfunding of key HUD programs that shore up and expand our supply of affordable housing. If the housing supply shortage continues to grow, are we likely to see continued housing inflation?
Yes, we are.
And housing is already becoming less and less affordable for low and middle income Americans. According to the National Low-Income Housing Coalition's 2023 Out of Reach report, a worker earning the minimum wage in New Jersey would have to work 2 full-time jobs to afford a modest one-bedroom rental home at fair market rent. Do you agree that increasingly unaffordable housing is a problem for the economy?
I think there are two things going on. One is a longer-term housing shortage, and the other is the pandemic effects and the associated higher interest rates, which are things that will pass through. When all that passes through and rates are normalized, we'll still have the underlying housing shortage, and it's going to be causing upward pressure on housing prices.
Now, the monetary policy report noted that, quote, home purchases by low-income households have fallen disproportionately more because mortgage lenders impose maximums on the ratio of a borrower's debt service payments to the borrower's income. I'm worried about how this dynamic will interact with the recently proposed capital requirements proposal, which, according to analysis from the Urban Institute, would disproportionately increase the cost of mortgages for Black, Hispanic, and low and income moderate borrowers. Given this, isn't there a risk that if the capital rules implemented without changes, that it could make it even harder for disadvantaged borrowers to attain home ownership?
There is
about to take control, Senator Warner. Welcome, Chair Powell, and Gus sends his regards. If you have time after the hearing, you ought to go by and see him. He's a dog in our office. But
I don't want to disturb his nap. But
but thank you for being here. I want to get back on this Basel III proposal. Senators Lummis, Coons, Gillibrand, and I sent a letter indicating our concerns with the current proposal. But I think it's also worth noting that the number of other organizations, a diverse group that are not normally aligned on policy. You got Bank Trades, National Housing Conference, NAACP, Habitat for Humanity, National Community Reinvestment Coalition, the list goes on, who have concerns with the current proposal. Here's my concern. I think we're trying to make the best of what was foundationally a bad proposal. And so I'm in the category of people who think that it should be reproposed because I think one of the reasons why I did not support Mr. Barr's nomination is I felt like we were going to be here. I mean, it was pretty clear to me before he ever got confirmed on the board that we were going to be in this place some months or years later. And here we are. And I think that the industry felt the same way. All of these stakeholders, some of them are in banking trade, some of them are on the other side of the spectrum. So I'd like to cast my vote or provide some weight to the idea that we should repropose it. And what we ought to do is talk about the reality of increasing capital, or the prospect of increasing capital requirements doesn't concern me. I think The prior Fed supervisor had made comments publicly that maybe we needed to raise capital standards. But what we did hear in this proposal, and I heard in that dialogue, is let's deal with puts and takes. Let's talk about raising capital requirements, but let's also talk about reducing the cost of the regulatory burden today if we can do it responsibly. There's no evidence of that in the current proposal, and I think that may actually produce a different set of comments that would be instructive to a final proposal that I think realistically will include some increase in capital requirements. So over what time horizon do you think we would expect to either try to make the best of this foundation or go back and take a look at a new foundation and repropose it?
You know, we're going to work through it as quickly as we can and should. I will say it's more important to get it right than it is to do it fast. We're not in a hurry. But my guess is we'll work this out over the course of this year.
Yeah. Well, if you take a look at the outsized cost of operational risk, the long list of concerns that I have publicly and privately expressed on the current proposal, I do think sometimes it's easier to knock down what I think is a poor foundation and build a better house. So again, just wanted to make that comment publicly. I got a question about shrinkflation. I tell you, some of these words that we come up with, but President Biden's using the idea of shrinkflation and chastising manufacturers for creating smaller portion sizes for potato chips. I'll use that as one example. But if you have rising input cost, and you're not able to control that, and you're in a marginal business to begin with, and now you're saying you can't even reduce the quantities, how does a business that's not making a profit make that work?
You know, I mean, we see inflation at the aggregate level as a mismatch between supply and demand.
Yeah.
And as we've seen supply get better and we've seen demand cool off a bit, it was very hot coming out of the pandemic. We see inflation coming down.
We saw food inflation between 2010 and 2021 at 18% over 11 years. And over the last 3 years, we've seen it at 21%. I think that we have a industry that's trying to actually provide products that consumers want, and now they're being chastised for trying to figure out how to make the numbers work. So this whole idea of shrinkflation is just confounding to me. I'm going to submit some for the record. I want to stay on time. But I have a question. I think the chair mentioned, if I misunderstood this, I'm sure the chair will clarify, but I thought in his opening comments, he suggested that stock buybacks and paying out dividends were a key factor in inflation. Do you, as just a matter of policy, see stock buybacks and dividends as one of the top 5 reasons we're experiencing the inflation we have right now?
First, I guess I see stock buybacks and dividends as just the same thing in a different form. And I don't know, I wouldn't comment on anything the chair even may have said.
Yeah. Well,
I'd like to avoid that.
I don't think, I'm not going to ask you about policy because I think you're consistent on that, but I just can't imagine that if we decided to outlaw stock buybacks and dividend payments, that would have a material effect on inflation. So I'm not going to ask you to respond to that, but there are some people that by inference you could assume that they think that would be helpful. I just, for one, I'm not an economist, but I just can't imagine that it would be one of the things that would make your job easier. Can you at least opine on that?
Banning stock buybacks and dividends?
Yeah.
Yeah, I think that would be quite a change in our capital markets.
Yeah, me too.
I mean, shareholders, this is just money going back to shareholders from companies that have nothing to do with it.
Okay. Thank you, Mr. Chair.
Well done, Senator Tilley.
Across the country, where, at least according to the California Department of Housing and Urban Development, renters in San Diego are paying about 50% of what is, they're spending more than 50% of what is considered affordable. And statewide, the majority of renters, more than 3 million households, are spending more than 30% towards rent. Nearly 1/3, more than 1 in 5 million households pay more than 50% of their income towards rent. And the Chicago Fed President Goolsbee even referred to housing as a missing piece of the puzzle in the Fed's path to lower inflation. So to the continued conversation, and I know a point that you've made that about how inflation has a disproportionate impact on lower income households who are focused on spending more of their monthly budgets on housing. How is the Fed's monetary policy impacting the supply of affordable rentals?
I don't know that we're affecting the supply of affordable housing. If you think of affordable housing as something that's connected to some sort of government program, that's not our bailiwick. I mean, clearly interest rates do affect the affordability of housing, though.
And there was a key point that you made in an earlier, I think, reference about and in your response to Senator Smith about the monetary policy and the calculation of rents. Can you just spend just briefly talk about that? I want to have one last issue I want to get to before I run out of time.
It's hard to talk about it briefly. It's actually very conceptually challenging to think about housing inflation. Do you include the costs of financing it? Do you include the sale prices? And the answer is we don't. We convert ownership into an imputed rent, and that's 2/3 of homes are owned. And then we actually measure rents, but leases only turn over once a year, so you look at market rents, and what's happening with newly signed leases may be very different from what was happening a year ago. So it's complicated, but the good thing is we understand all that, and we look through that. We look at housing services overall as one of the three important categories, along with non-housing services and goods inflation.
Thank you for that. In the line of affordability and housing, again, sort of very general, I think, to the broad monetary policy and state of our economy and unique to California. And I raised this with Secretary Yellen when she was here as well, the insurance gaps that are presenting themselves due to the impact of climate change. Where 1 in 5 residents in California live in areas that risk flooding, and all 58 counties have a history of flood damage. And we are seeing more and more insurance providers, home insurance providers, actually withdrawing from the state. You and I had talked a little bit about this in our preparation for today's conversation. Can you talk to me about or share with us how it is or what you think the impact might be of this sort of protection gap in insurance coverage on the overall stability of financial institutions in the broader economy?
So it is clear that insurance of various different kinds, housing insurance, but also automobile insurance and things like that, that's been a significant source of inflation over the last few years. And it's to do with a million different factors. It's nothing that we control from a regulatory or supervisory standpoint. In the longer term, companies are withdrawing from writing insurance in some coastal areas, and you got to think 10 years from now, how are you going to get housing insurance? And maybe the government will have to step in, but it's a significant issue.
Thank you, Chair Powell.
Thank you.
Senator Senator Vance of Ohio is recognized.
Thanks, Mr. Chair, and my gratitude to you and the ranking member for doing this hearing, and thank you, Chairman Powell, for being here. It's good to see you again. I think these hearings are always very important. Actually, give us an opportunity to sort of provide some oversight to what's going on at the Fed and better understand some of the things that you guys are doing that affect our constituents. Now, I wanted to sort of focus on the Basel III regulations, Chairman Powell, and specifically the way that they have. There have been various proposals to sort of draw them down to focus on the regional banks. And to just go back to sort of one of the most significant crises, obviously, in our banking sector, of course, the collapse of SVB and First Republic. You and I have spoken in private and I believe in public, but one of the concerns that I have is when we talk about increasing capital requirements on the banks. If the banks were under higher capital requirements in the run-up to the crisis, there's maybe an argument that SVB, for example, would have bought more long-term treasuries, which would, of course, would have exposed their balance sheet to even more treasury bond risk. And that, of course, would have maybe hastened the collapse of SVB. And I guess I want to start here with, when we talk about, some of the Basel regulations, what was the original intent? In other words, what was the original sort of proposal for which banks would fall under those regulations and which would escape them?
You mean this time around, or I mean earlier on?
This time around.
So it's the 37 largest banks. It's down to, well, there's 4 categories of banks, including the G-SIBs, and this is down through the 4th category. The proposal that's out there now, I think, does extend to Category 4 as well as 3, 2, and 1.
So what's the minimum assets under management that you guys have proposed, the current
billion.
Basel regulations?
100 billion.
100 billion.
Yeah.
And sort of that sort of gets to my concern here, because I know there's some discussion about whether you'd apply them at $700 billion of AUM or $100 billion of AUM. And maybe you could just sort of walk me through that decision process at the Fed, where you guys are and what would sort of justify drawing down from a $700 billion threshold to a $100 billion threshold.
So there's the G-SIBs, there's the 8 identified G-SIBs, and then there's one category too, I guess, and then there are the big regionals, and those tend to be well-known big regional banks, and they're Category 3, and one of them's a 2, I guess, but they have a different tailored level of regulation. And then Category 4 had significant tailoring, and the question is, we have to ask the question, since SVB was a Category 4, we've got to ask the question, what, if anything, needs to be changed in the way they were regulated, supervised from a capital liquidity standpoint. So there was tailoring all the way down, and then below 100, of course, those are community banks, and that's a different regime as well. This makes sense. We want to have, a diverse banking sector. That's a great benefit to our country, and very unusual for an advanced economy. So it's something we want to preserve.
Yeah, and I'm sure you know, Chairman Powell, but just to put this on the record, I mean, a lot of the commercial lending, a lot of the real estate lending, a lot of the consumer lending, about half of that lending, consumer lending, is provided by the regional banks. I believe that Huntington, in my home state of Columbus, is the #1 SBA lender in the entire country. So these, to your point, I think these do provide incredibly important benefits to our economy. And you hear a lot of people talk about the American economic miracle, and I do wonder if part of that is because we don't have the same type of financial system that has sort of dominated in Western Europe and other first world economies. I'm curious, in the process of amending the Basel requirements, have you guys made a decision about where to set the threshold yet, and when do you expect to set that threshold?
We haven't made any final decisions. We put out for proposals some months ago a proposal, and we've gotten a lot of comments, as I'm sure you're aware. We're chewing through those and digesting them, and we're just beginning now to sit down and talk about the changes that we'll appropriately make to the original proposal.
And when do you expect to sort of issue a final proposal?
I think it's going to take some time. I think it's more important to do it right than it is to do it fast. My guess is we'll get through this and be done over the course of this year, but okay. It could be faster than that. It could be slower than that. So I'm wondering, just being mindful of time, I have about 30 seconds left. Would you be willing to commit to say that in the process of amending, the Fed will remove the regional bank drawdown and limit Basel's application directly to the G-SIBs or $700 billion or above? I can't get that specific at this point, but we're clearly looking at the whole tailoring issue. I appreciate that. And again, I just repeat, Chairman Powell, given what actually happened with the banking sector with SVB and First Republic, I just encourage you guys not to apply a regulation that doesn't actually solve the underlying problem. And I fear that if you apply this to banks of $100 billion and above, you actually are doing just that. So with that in mind, I'll yield. Thanks, Mr. Chair.
Thanks, Senator Vance. Senator Tester of Montana is recognized.
Yeah, thank you, Chairman Brown, and thank you for being here, Chair Powell. We appreciate you.